Hey guys, welcome to another episode of the Genesis Blog Podcast. Today we have for you another protocol analysis, and this time we're covering GMX, which I'm sure some of you all at least have heard of. So with that, let's begin. Yash, over to you.
Right. So GMX it's basically it's a decentralized exchange where users can trade, spot markets and perpetual swaps for supported assets on the GMX network. So GMX, we'll get into the assets and stuff later, but GMX is built on Arbitrum, which is the layer 2 Ethereum scaling solution, as well as on Avalanche, which is an alt L1. As you can see, they're targeting high throughput blockchains because you require that kind of throughput for all the transactions that take place on dexes, and something like Ethereum probably wouldn't support such a high volume. So anyway, GMX allows, as I said, allows users to trade different assets that are supported in the different pools, and it allows users to either just go long or short like a normal spot market, or they can buy perpetual swaps, which is basically a future which you can trade indefinitely into time, and they allow users to take up to 30x leverage. So that means they can borrow up to 30 times their collateral value. So yeah, that's how it works. So the key selling point of GMX is that unlike traditional dexes that currently use an AMM model, where it's a constant product function where the product of your two assets has to equal a constant, and the price keeps fluctuating depending on that, which leads to impermanent loss, and liquidity providers need to constantly arbitrage to get the price back to its current market price. But GMX, they actually use an Oracle pricing model. So they use Chainlink to basically get price feeds from centralized exchanges like Binance and FTX to get the true price of an asset without the need for LPs to, arbitrage to find the true price or discover the true price of the asset. And that leads to way lower slippage during trades, which is very important if you're conducting trades with a high volume trades. It's way easier to conduct it on GMX than it would be, for example, on Uniswap. So yeah, any questions? Do we go further into how exactly it works?
Yeah, I think that, overall, you've explained it pretty well. Just for the viewers, what is a perpetual swap? Because this is a derivatives exchange essentially, right? So a perpetual swap is a crypto native product that's not really seen in traditional options markets. So do you want to explain what that is quickly?
Right. So future basically gives you the right to buy or sell an asset at any particular time in the future. So if it's a 3-month future, you have the right to buy or sell the asset at a particular price decided today, 3 months into the future. What a perpetual swap does is it extends that timeline indefinitely. So you can theoretically go long or short on an asset with leverage for as long as you want to, and you can settle on whatever date you feel like, as long as you keep your collateral value above the liquidation price that is decided based on how much leverage you take, basically. So yeah, that's what a perpetual swap is.
Yeah, so it's actually like very useful as a financial instrument in general, and we've actually written about this, or I wrote about it on my blog before Genesis blog. It's on the Genesis blog Substack, but there's a very obvious real world application of perpetual swaps as well. And Paradigm wrote an article called Everlasting Options that were based on the concept of perpetual swaps, and it essentially using perpetual swaps instead of rolling options contracts in the traditional financial world would actually solve for a lot of inefficiencies that plague rolling options contracts right now, such as human error and just general strike price inefficiency. So just in general, perpetual swaps are by themselves a very real world applicable utility of DeFi. And we've been talking about, how can all these things be applied in the real world, and what is the actual real world utility of it? Well, this is what it actually is. A perpetual swap applied to rolling options makes that market significantly more efficient.
Yep, definitely. I mean, why should people be restricted to 1 month, 3 month, 1 year futures? Like, I mean, no one can decide exactly the time frame when they start trading, right? You should have some kind of leeway as to when you want to exit your trade. And I think perpetual swaps does that because you can literally end your trade whenever you want to. So I mean, if your coin runs up 50% in a day, you're not stuck having to wait it out till your options or your future expires to cash out. You can cash out right then and there, which is amazing.
Exactly.
Anyway, so now I guess we can go on to how exactly GMX works. So basically, the way it works is there are two tokens in GMX. One is called GMX, obviously, and the other one is called GLP, with the LP probably standing for liquidity provider. So what users need to do is that there is a pool of liquidity called the GLP pool with a bunch of different supported assets. So for example, on the Arbitrum chain and the Avalanche chain, there are two separate liquidity pools, and users can go and deposit liquidity into that pool, and they will be when they deposit liquidity, they will mint GLP tokens essentially, which is a liquidity provider token, which represents a share of that pool. So for example, if I go and deposit Ethereum into the GLP pool, my Ethereum goes in the pool and I get GLP tokens in a proportionate rate that is basically my equity, I guess, over the pool. And then traders can go and buy and sell, spot or perps, whatever they feel like from the pool. And the pool essentially serves as a counterparty to all these traders. So for example, if I'm a trader and I go and I buy Ethereum from the GLP pool, the GLP pool becomes my counterparty. And essentially, if I make money on my trade, the GLP pool loses money. And if I lose money on my trade, the GLP pool makes money. So providing liquidity to the GLP pool is essentially a bet on your part that traders will lose money long term and the GLP pool will make money. So you're essentially betting on the house while the traders are the gamblers who come to your casino. And the GLP pool then earns fees in the form of market making fees, trading fees, as well as borrowing fees because they provide leverage. So your trader has to provide a fee because they are taking that leverage. And the fees are then distributed in a 70-30 proportion. So 70% goes to GLP holders and who are essentially liquidity providers. And the other 30% goes to GMX holders who are staking their GMX. So essentially, it sounds complicated, but what they're basically doing is splitting up the fees between liquidity providers and GMX holders. And this kind of works in most dexes where fees are split up between liquidity providers and the holders of the token. And the only notable exception to this is Uniswap, where only liquidity providers own fees, while the Uniswap holders essentially are holding a governance token and have the option to turn on a fee switch in the future. So yeah, that's how the entire system works. And it makes a lot of sense to split it up like this because you can then decide whether you want to take on that risk of being a counterparty to traders, or you exclusively want to just earn trading fees and are betting on the long-term growth in the number of users on the protocol and are not taking a bet on whether traders are going to, gain or lose money, essentially. So yeah, before going forward into stuff like, the trends and the launch and the use cases and stuff like that, do you guys have any more comments, thoughts, questions?
So essentially the GMX token is, what is the use of it? It's only to stake.
Yeah, so you stake and you earn fees, and then it's also a governance token. So you can govern the future of the platform. If you want to adjust fees or any of those kind of proposals, you can put forward as a GMX holder. So it's a governance and utility token, and it makes sense to do it like this because, on the one hand, you need the project to be decentralized and it needs to be governed by the users of the platform or the people who hold GMX. And at the same time, liquidity providers also need to be compensated. But liquidity providers shouldn't have any say over the governance of the platform, right? Because they are there exclusively to provide liquidity and earn a fee for doing so. So it makes sense to split it up like that. But the GLP token is not something that's publicly traded. you can only go and buy GMX on the open market. GLP is only minted when you provide liquidity.
And you can't,
If that makes
so
sense.
does that mean that you can't transfer it? Like I can't list it on any secondary marketplace
No.
and exchange? Oh, okay. So
You can't.
So it's essentially like a non-transferable NFT that represents my proportion of the GLP pool.
Yeah, you can say so.
It's
And
not,
as long as you hold,
really,
yeah. As long
it's
as you
not like
hold, like
exactly
you,
that. Yeah.
yeah. So you've deposited liquidity and you hold the GLP token, because as soon as you deposit liquidity, it mints GLP automatically into your wallet, and you earn fees as long as you hold GLP. And then if you want to redeem your GLP and get back the base assets that are part of the pool, you just burn your GLP and you get back your asset and you stop earning fees. So it's very simple that way.
And the pool that you deposit into, it consists of many different types of assets. So it's
No, so currently, so the Arbitrum and Avalanche, they have different GLP pools. Okay, so the Arbitrum pool and the Avalanche pool are separate, and you have to provide liquidity to them separately. So the Arbitrum GLP pool supports Ethereum, Bitcoin, Chainlink, Uniswap, and 5 different stable coins. So there's USDC, USDT, DAI, FRAX, and MIM. And the Avalanche pool supports Ethereum, AVAX, Bitcoin, and 3 stable coins. So yeah, they're different constituents, but I think through governance proposals, etc., they can keep adding assets to these pools.
And when I want to deposit my assets into a pool, it's essentially like an omnibus pool, right? So it's not segregated.
Yeah.
Like the assets are all in one pool. So
exactly.
Bitcoin, all of them it's all in one pool.
Yeah, and that leads to more efficiencies, obviously, because you don't need to provide liquidity for, just a trading pair. You provide whatever liquidity you want to provide into this one pool.
Okay, cool. I think that makes sense, because that was the question I was going to ask.
So in this model, slippage is only a function of how deep the liquidity is?
No, so there's actually zero slippage, right? Because normally the way DEXs work is they work on an AMM model.
Right.
So impermanent loss is like an inbuilt feature, or not a feature, an inbuilt curse, I guess, where liquidity providers are constantly, up or down depending on the price of the asset itself. While in this, the price of the asset is determined by oracles. So there's no need for liquidity, like liquidity providers will not experience any impermanent loss, because the price of the assets is not based on this constant function or constant product model. It's just based on what the market price is. Like there's no need for price discovery on the platform itself, because they are getting the price from external trusted sources like Binance and FTX using an oracle like Chainlink.
Okay, and then so there's no a situation or scenario where the total deposits of one particular asset goes less than the total amount deposited of that asset by LPs. So like there's no situation where LPs will not be able to redeem all of their assets.
No, there isn't, because they also have it's basically the assets get adjusted based on the demand and supply of the asset in the pool. So they always adjusted. They adjust the fees you need to pay based on the demand for the asset. So if the demand for the asset is higher, you also have to pay higher fees to buy or sell that specific asset.
And that incentivizes more people to put the same asset to reach some sort of equilibrium.
Exactly.
Okay, got it. And also, has the team given any explanation of why they chose Arbitrum first, and why not say something like a Solana?
So I was going to get to the team later, but we might as well discuss it now, I guess. So the team is completely anonymous. No one knows who exactly they are. They obviously have their pseudonyms on Twitter, but by and large, no one has any idea who they actually are. So it's like a team of, I think, 11 people, 4 developers, 1 marketer, and, a bunch of other people. But yeah, they've said they built this product on Binance Smart Chain under another name. And then they finally shifted to Arbitrum, I guess, once, Arbitrum finally showed promise and people were using it. So they moved to Arbitrum because I guess they wanted to still be in the Ethereum ecosystem, but obviously couldn't be on Ethereum. And then they moved to AVAX. So I guess their plan is to integrate with as many EVM compatible chains as possible in the future. So maybe they'd go to Optimism next. They'd look at like something like Neo Protocol or Phantom or any alt L1, probably other than Solana would be looked at, Solana and Cardano.
I think that, there are lots of reasons. I mean, for example, if I wanted to build something like an options market, I wouldn't really build it on Solana because sure, Solana's got high throughput, but it's also got crippling problems of where its infrastructure just goes down. So, and when you need, a sub-second confirmations, you don't want a situation in which your probability that the chain will go down is, is actually like much higher than non-zero. So that's one thing. And another thing for Arbitrum is that to date, it's actually proved to be very performant. The products that have been built on it have been really good. I mean, obviously GMX is a very big contributing factor towards that. But actually, if you look at Dopex is built on Arbitrum as well. And Dopex is also another options protocol. And it's a really, really good options protocol. Actually, kind of similar to GMX because it's also got a team of pseudonymous founders as far as I can remember. But yeah, so it's why you would choose that. And I'd say AVAX because Avalanche is actually a very flexible blockchain. Like they have, I don't know exactly about what their roadmap is going to look like, but they have, the ability to have L2s, so like rollups on top of Avalanche. They have the ability to have subnets, which are essentially application specific blockchains. So whatever GMX wants to do, it has the flexibility to do on Avalanche. Like for example, they could go in the DYDX model of actually becoming an application specific blockchain, right? If they wanted to do that. So Avalanche does give them quite a lot of flexibility to do those things. And again, the EVM compatibility is really important. Like you wouldn't want to restrict your user base to something like only Solana by building on Solana first, because the majority of folks in crypto, at least currently, build on Ethereum and build on Ethereum layer 2s, right? Like, so, I think there are lots of very good reasons for choosing Arbitrum and Avalanche first. And I actually think that those are two of the blockchains that make a lot of sense.
Yeah, agreed. So one thing I forgot to mention is that the fees that are paid out to, GLP holders and GMX stakers are actually, on Arbitrum, they're paid out in ETH, and on Avalanche, they're paid out in AVAX. So they're actually, there's not some random token as such that is, being paid out as fees. You're actually earning real yield in the form of ETH and AVAX for being a liquidity provider or GMX staker, which is, GMX, I guess, is one of the protocols that have started this entire narrative of real yield that we're seeing nowadays, which is great, right? Because now you don't have some useless governance token that you're being paid, paid as in fees as an LP or as a GMX staker. You're owning real yield and you get to take that real yield home just by being a holder, which is, was not how it was done earlier during, DeFi summer of 2020.
Yeah, I think that's a really good point.
So, so let's talk about the trends supporting, GMX. So spot and perp trades account for almost 95% of total trading volume in 2021. And both types of trading saw large increases, but spot trades increased 130% year on year, while perpetual swap trades increased almost 500% year on year. So there's a massive demand for, perp trades in crypto that is growing a lot quicker than spot trades, I guess, because perp trades are an easy way for people to get leverage, and there's not been easy access to leverage just for, normal stock trades and stuff like this before. And crypto allows you to do this in a permissionless way, which is why I understand why the demand is increasing so quickly. And so DeFi perps or your decentralized exchange perp trading has not been a thing until like just a year ago. Before that, all perpetual swap trades happened on centralized exchanges for crypto products. Like Binance is still the biggest perpetual swap trading venue for, all of crypto. But DEX perpetual volume has increased in market share from 0% essentially to 3% in less than a year. And it's a massive market in worth around $1.7 trillion. This is the crypto perp market total market value currently, of which only 3% is currently conducted by DEXs. So you can imagine how rapidly that'll grow, given that on DEXs you don't need to provide KYC and you're not paying exorbitantly high fees like the way you pay on centralized exchanges. So there's a massive runway for growth over here, and GMX is like really well placed to take advantage of this growth because it has one of the best UIs of any perp DEX I've ever seen. It has zero slippage because it doesn't use an AMM model. It uses oracles to price, and it also has low fees, which are lower than Binance and FTX. The only problem is that they only support 4 assets really to trade with and stable coins. And even though they only support these 4 assets, they're seeing massive volume increases month on month, year on year. And it's only been about a year since GMX has gone live, which is pretty crazy growth if you think about it. And the thing is, all the fees are accruing to GMX and GLP holders instead of, Binance taking just all the fees and, not really helping LPs or anything that much. So yeah, definitely something to watch out for. The growth of DEX perps. So some other just key facts that I guess are useful for people to know before we get into the tokenomics itself. So GMX, before it launched on Arbitrum, it was on Binance Smart Chain under another name. And then they migrated to Arbitrum and launched as GMX in September of 2021. And then they launched on AVAX in Jan 2022. It's seen significant traction in terms of fees collected. The exact number is, I think it's around 55 million in total fees collected by LPs as well as GMX takers. And there's all this fees is real yield in ETH and AVAX. So it's not just the value of a token that's being paid out as token emissions. It's actual $55 million of actual fees being paid out to people providing liquidity, which is kind of crazy. And then we can talk about the investors. So the great thing about GMX is they actually raise.
Sorry, Yash. Just one question on what you just
mentioned.
The fees that are paid out in the blockchain's native assets, the ETH and AVAX, that's possible because of how is that possible? Is that because the traders pay the fees in that?
Yeah, the traders are paying. I mean, if they're using Arbitrum, they're paying fees in ETH, and if they're using AVAX, they're paying fees in AVAX, and this is just being directly paid out.
Even if they're trading the other assets that are listed, so non-ETH and non-AVAX assets.
Yeah. They are going to be paying a transaction fee in ETH or AVAX, depending on whether it's Arbitrum or Avalanche.
So a user has to have ETH or AVAX in their wallet to perform any trades, irrespective of asset.
But that goes for, anything, right? If you're performing any kind of trade on Uniswap, you're going to be paying fees in ETH only, right?
Yeah. No, I'm just wanted to understand how they allow this fees to be in ETH, because Uniswap, the ETH that you pay is gas. It's not the Uniswap transaction fee. The Uniswap transaction fee gets taken out from whatever asset you're swapping.
Yeah. So this is a blanket fee on all trades being done. It's still paid out in ETH or AVAX. So I guess, yeah, you're right. It's different from Uniswap in that aspect.
Got it.
Right. So yeah, let's talk about the investors, but there's not much to talk about since they don't have any early investors. They didn't raise any VC money. So, there's no VC tokens that are vested currently that are going to flood the market in the future. It's all been bootstrapped, and even investors who wanted to, create big positions of GMX have had to just buy on the open market like the rest of us. And I think that is pretty unique for the crypto space, where normally projects, raise money from investors at really, really small valuations, and then investors dump on retail token holders and just kind of continue that Ponzi-like feel that, perpetuates throughout crypto currently. So yeah, that's great because, there have been some prominent investors like Block Tower, but they have had to buy on the open market like the rest of us. And it feels great to be on equal footing for once with VC funds, because it's just normally not the case. So I think in terms of the way they've executed, even though they're an anonymous team, they have definitely thought only about the users and not about, their own selfish interests, or, trying to make sure they make money before it's released to, retail traders. They just want to create a great product, which is, not common to see in crypto. And then, thoughts from using the protocol, it has a really clean UI, I guess. It's very clear what your collateral is, what your entry price is, your exit price, your liquidation price, the fees you're paying. They make it very obvious to the user, and you don't have to really do any kind of mental arithmetic to figure out, how much money you've put in, what is your liquidation price, when will you get liquidated, and how much are you paying in fees. And they also make it very clear that you're going long an asset, you're shorting an asset, or you're using a perpetual swap and you're taking leverage. And they also let you, they make it apparent to you how much leverage you're taking. So although, trading perps is not something I recommend an average retail user do, if you were to go and trade on this platform, if you have just a basic understanding of what a perp is, you will be fine. Like, they're not trying to make it confusing. They're trying to make it as easy as possible. And because it's not a centralized exchange, there's none of that KYC bullshit. You just need to connect your wallet and you're good to go. That's all you need to do, which is crazy. Right. So I guess before we get into tokenomics, do you guys have any more comments, such questions?
No, I think I'm good. Yeah, I think that you explained it pretty well.
Yeah, same.
Cool. So let's get into tokenomics. So as we know, tokenomics is, about the demand and the supply of the token. So first, before we get into demand, let's, talk about the supply. So GMX is like the protocol's utility and governance token, as we mentioned. And that is the token that, has a cap supply, and that is what you can go and buy on the open market if you believe in GMX as a product. So GMX has a forecasted maximum supply of 13.25 million tokens. But that 13.25 is a number that will probably never be reached because of the way they've structured it. So 6 million of that 13.25 total is they migrated it over from the previous platform that they had built on Binance Smart Chain. So I think that was called Gambit. It was like a similar product, but it was launched on Binance Smart Chain. So they migrated over those tokens to, Arbitrum as GMX. So that's 6 million of them. 2 million is paired with Ethereum on Uniswap for liquidity. So if people want to go and buy and sell GMX, the best place to do it would be Uniswap because it has the deepest liquidity. 2 million GMX is reserved for vesting from escrow GMX rewards. We'll talk about that later, exactly what that means. Another 2 million GMX tokens are currently completely off market. They're not even being minted, and they are for a floor price fund. And we talk about that also, but essentially the floor price fund is a way to ensure that GMX always has a minimum price that it should trade. And if it goes below that minimum price, then these 2 million GMX tokens can essentially be used to buy back tokens to ensure that the price of GMX comes up to that certain minimum price that they want to. And then 1 million GMX is reserved for marketing partnerships and community developers. So that is essentially a spend for them in a way. And then the remaining 250,000 GMX tokens are for the team, distributed linearly over 2 years, which means that of 13 million tokens, only 250,000 are reserved for the team. So they clearly are not trying to cash grab and keep a large amount for themselves. And it's also vesting over a term of 2 years. So they have, sorry. I don't know what happened there. But yeah, they have enough reason. We have enough reason to believe that they are not trying to rug us or something like that, because they have a very small portion of the amount of total tokens. So that's the supply.
Yash, how does this work? This floor price fund, because to buy back you have to sell. So how are you like? So to use the GMX tokens to buy back other GMX tokens, you still have to sell GMX tokens. You know what I mean?
So let me think about how exactly to explain this. So these floor price flow tokens have not yet been minted, which means so essentially okay, we get back to that. It's kind of tough to explain it right now. Let me just think about it while I explain other things and we get back to it. Then we can talk about the value accrual of the token. So essentially the value accrual comes from three different things. So the first is the Ethereum or AVAX rewards that we spoke about. That's paid out in, fees essentially. The second thing is escrow GMX, which is essentially, I guess you could call it liquidity mining, kind of like Curve and VCurve. And the third thing is multiplier points, which I would kind of say is like the boosting of rewards on Curve. So they are kind of trying to implement V tokenomics without actually implementing V tokenomics. But the way they've done it is kind of weird because escrow GMX and GMX earn exactly the same fees. So you don't need to convert your GMX into escrow GMX to earn fees. So I'm not sure exactly why they've implemented escrow GMX. And if any of our viewers understood why they've done that, please get back to us. But essentially, the rewards are paid out. So it's a 27% APR currently, of which 10% is paid out in Ethereum or AVAX, and the remaining 17% is paid out in escrow GMX. And escrow GMX, you have to basically lock up for 1 year, after which you can unlock and, earn the fees that have been earned over the entire year, essentially. So yeah, you have any questions? I'm sure you do. And even I had questions when I read about this. I wasn't sure exactly what the point of escrow GMX was, but yeah.
Did they not go over it in the docs or anything? Because honestly, like just listening to you about the escrow GMX, it seems like it doesn't really make any sort of sense because it's essentially trying to ask you to lock up your tokens, forgo liquidity, and not get any benefits in return.
Yeah, so I think even in their docs, this is I'm gonna read it word for word. Okay, so they wrote a summary of rewards and mechanics. GMX earns ETH/AVAX, escrow GMX, and multiplier points when staked. That makes sense. Escrow GMX earns ETH/AVAX, escrow GMX, and multiplier points when staked. So they are doing exactly identical things. Either if you stake it as just normal GMX or escrow GMX, you're earning the same rewards. So I'm not sure why.
This is a weird point. Yeah. So okay. So think about it, right? Like, okay. So the first transaction a user will make is to stake their GMX. So they will stake the GMX and they'll get escrowed GMX back, right? They don't get actual like GMX back. They get escrowed GMX back.
Yeah.
Now, like the reason that I think that they've done this is because when the user gets escrowed GMX back, they can't actually like redeem it for GMX in the market for up to a year. That means that any rewards that they distribute are then intentionally locked up for at least a year. That means that when the rewards are given in terms of GMX, it does not actually impact GMX price for a significant amount of time. And what do you do when you have escrow GMX? You're not just going to hold it and wait for it to turn into GMX, right? You're actually going to be staking it because you want to get more of it. And then you just go into a cycle where you're creating more and more escrow GMX, but that is not unlocked for about a year. And that incentivizes people to keep the GMX locked up and to keep essentially to keep like the escrow GMX staked and locked up. That adds to the theoretical security of the network. I mean, I don't know about the last point, but at least like the other
not really
points,
security, just security in terms of price action, right?
Exactly, security in terms of price action. So I guess that, if I had to, just try and understand why they would do this, I would say that it's this. Just to try and incentivize people to stake their escrow GMX and literally just hold on to GMX for as long as possible. And I don't think it's like the worst thing in the world, because when you come to this kind of conclusion, because what it does is it enables people to interact with the protocol for a larger amount of time. Although, I guess the boosted rewards or additional rewards portion of what other V tokenomics models do might be something that could be explored, but I to like add incentives. But then again, by doing this method, they are ensuring that they don't have to release too much more GMX or escrow GMX into the ecosystem, while still ensuring that the holders keep on staking their GMX, right? So I think that this might be a reason why they're doing it, but again, I can't confirm. And again, viewers, if anyone has additional information about this, would love to discuss.
Absolutely. So coming back to your question about the floor price fund. So, I mean, I thought about it in the meantime, and the way that they buy back is because, so GMX earns yield, right? So there's 2 million GMX set aside that is also earning yield, but is not currently on the market. So when they decide to, bring that GMX onto the market, that GMX would have also earned a certain amount of yield. So they can use the yield and fees earned to buy back more GMX tokens to ensure that there's a minimum price for GMX. So the minimum price for GMX is essentially the amount of fees earned by the 2 million GMX. How many GMX tokens can they essentially buy with the fees earned from 2 million GMX tokens is the minimum price of the floor price fund. Does that make sense?
So the GMX tokens earns yields from where?
The 30% of the platform fees are paid out to
Got it,
GMX,
got it.
right? So we are part of that.
Understood.
And these 2 million GMX tokens would be governed by the rest of the GMX holders.
Right.
So, I mean, currently, I think the minimum price of the GMX floor fund is, I think it's around $0.7. So the token will have a minimum value for sure. I mean, you can be guaranteed of that. So that's one great thing that, this floor price fund introduces. It's essentially a way for the protocol to keep funds aside for a rainy day, essentially, right? So if it goes below this minimum price, the GMX DAO, I guess, by then will be able to activate these 2 million tokens to get the fees from these 2 million tokens to buy back other GMX tokens from, people.
And I think that's actually, like putting a floor, it's similar to actually what these reserve fund type of products or projects like Olympus have been doing, because Olympus also has a treasury, right? Like theoretically, the value of the Olympus token shouldn't actually go below the value of the treasury, because then you have an arbitrage opportunity, right? Because that token should be theoretically worth as much as like you get the point. So I guess that this is that kind of trying to keep a floor of it. I don't know like fully why exactly that's necessary for something like GMX, like something like a GMX token. I guess it's to maintain like a minimum floor, like stable value or something like that. But if the token price drops to $0.7, I think that they're going to have much bigger problems than maintaining like a floor price.
I mean, the hope is that as time goes on, GMX holders accrue much more fees than they currently do, and that is it's a quite possible future, right? Because currently GMX is only supported on Arbitrum and AVAX in a very limited number of assets, but because they are so efficient at executing trades, they can just keep integrating with more and more aggregators. And the way aggregators work is they will execute a trade in the best possible way for the user. So if someone wants to buy Bitcoin or Ethereum using an aggregator, and GMX is integrated with this aggregator, GMX will be the most efficient place to conduct whatever trades the aggregator needs to. And as the aggregator uses GMX, fees automatically flow into the ecosystem and to GMX stakers, right? So what they need to do is ensure that they are earning fees from as many places as possible, which means just going and integrating with as many chains and aggregators as they possibly can to make sure they can route as much trading volume as possible through that platform, right? So I wouldn't look at it at the floor price fund as like I wouldn't look at it now. I would look at it, what could it be in the future, assuming firstly just basically looking at the amount of fees they are earning over time and whether that is increasing. And so far the increase has been exponential. So I guess a good thing to do for anyone interested is is look at the floor price fund's minimum price over a period of time and not just currently what it is, right? Because you can't expect the floor price fund to be like, two-thirds or one-third of the current price. That's kind of crazy.
I think that makes sense. And that what you said about looking at it over time is a bit of an indicator of how the protocol has performed over time and how the floor price fund itself has performed over time. Like it's not obviously a linear indicator, but it is some sort of indicator that it's doing well. It's increasing in value.
Yeah, exactly. And so, I mean, let's talk about the total market that GMX is looking at currently. So currently the market for, like perpetual futures is, not perpetual future, just futures and options currently in the world is, I think, around $60 trillion. Of that, crypto, futures and options are worth around $1.5 trillion. And of that, just 3% is conducted on DEXs currently. Of that, around, I think 80% of that still is in DYDX. So GMX currently has a very small part of a very small part of a very small part of the pie. So the hope is, or I guess, I mean, if you believe in crypto, you'd obviously assume that more and more trading will go on to, crypto trading exchanges, as long as, they start integrating real world assets the way Synthetics is. And the second thing we would hope for is that the trading would move from centralized exchanges to decentralized exchanges. And if this happens, if it plays out the way you would want it to as a GMX holder, the total addressable market goes from currently around, I don't know, $100 billion to, I don't know, $10 trillion, right? You could see 100x increase in the market size itself for GMX. So, I mean, I think it's very tough to predict where GMX is going to go in the future because there's so many variables, because they completely rely on trading fees for users to accrue value. So they just need to increase the ways possible to earn fees. And the way it's growing, they probably can increase it a lot more than what it currently is. But it would rely a lot more on the team to make those integrations with aggregators, get themselves on other L2s and alt L1s, and just try to expand as much as possible as quickly as they can to capitalize when people realize the market opportunity in the future.
And the GMX token, it only exists on Ethereum, is it?
No, I mean it's a token that you can buy on all different kinds of decentralized exchanges and centralized exchanges as well, right? If they just hold it in their wallets, you can buy it.
Right. So but then it doesn't matter where the trading happens. It all accrues to the same pool of GMX.
No, buying the GMX token is not the same as trading on the platform, right? GMX accrues fees when either a user or an aggregator uses the GMX platform to conduct trades. Buying and selling the GMX token is completely separate from the way the token is valued. Buying and selling is just a bet. I mean, you'll buy the token if you believe that GMX as a platform will accrue more and more fees, which will make sure, or make people want to buy. There will be continuous buying pressure on the token throughout time because of the fees it's earning, and because the fees over time can increase, and you would sell if you don't believe that.
Okay, got it.
So yeah, I think that's pretty much it. It's GMX is like a new way of working for a DEX, I guess, because mostly DEXs either use an AMM model or they use a central limit order book. They don't use an Oracle pricing system, and I'm not sure why they haven't, because it makes a lot more sense than the AMM model where there's a constant need for price discovery. Here, the price is already there and they're just integrating that price onto their platform from other platforms, which I don't know why no one has thought of before. And I mean, yeah, I get the AMM model is a way to provide liquidity, but this makes a lot more sense in terms of conducting large trades and ensuring that liquidity providers are not the ones who get screwed for providing liquidity.
Well, oracles is just another dependency, right? Then you introduce another variable. EMMs are based on math, so it's less subject to randomness really. But in the
But that's
downside
a
is the
trade-off.
impermanent loss.
Yeah, I mean,
But
you're not really, an Oracle is not going to go down, right? It's Chainlink is also a decentralized protocol, so you're not relying on any centralized party here, right? So there's no centralization risk. The risk is maybe inefficient price discovery, but I feel like it's still more efficient than an EMM, right?
Yeah, I mean, I definitely need to look into how oracles work. When I say dependency, I don't mean centralization risk. I mean just possible flaws or possible vulnerabilities on how an oracle actually performs or how it functions.
Yeah, I guess this also allows you to, provide one-sided liquidity. You don't need to, as an LP, you don't need to provide liquidity in pairs like the way you need to on Uniswap. You can just provide one of the supported assets and then you mint GLP, right? So it's an easier way to provide liquidity, and it also, you're not just restricted to two assets. So, I think it's a win-win for everyone. And we have seen multi-sided pools before. I think Balancer was the one who pioneered it, if I'm not wrong. So this is just the same thing, but instead of the constant product formula, they're using oracles. And for the life of me, I can't figure out why no one has done this before and why it took so long for someone to think of it. It doesn't make sense in some ways to me, but yeah, that's where we are.
I think like a real deep dive into how oracles work will give you an answer. I haven't done that, but I think that's where the
Yeah,
question arises.
definitely. What about you, Sid? Anything else to add?
can you hear me?
Yeah, we can
You
hear
can't
you.
hear me, right? Oh, you can hear me. Okay, good. Because there was an issue. But yeah, I think like from the oracles question, right? I mean, it is a trade-off because you are dependent on oracles to price things, and in derivative markets where even the tiniest minuscule proportion of price difference can cause high it can literally cause you to get liquidated, right? I think it's extremely important for an oracle to be completely performant, and the data sources that oracle is using to be very trusted. So essentially, right, like let's say that if you're using an oracle and an oracle is getting its price off of a centralized exchange like Binance, I mean, like, okay, you like we've said before, you're as decentralized as like the least decentralized thing in your stack. In this case, if an oracle is dependent upon Binance's price feed to be able to pull data into GMX, and Binance's price feed is centralized, then GMX's price feed is centralized. So that is the trade-off. But I think in derivatives markets, again, and it's not like I'm saying that, oh, I disagree with the trade-off that they're making, because I actually agree with it. You have to have pockets of centralization, because centralization does give you speed and efficiency, and there have to be some places in which you're just gonna have to end up trusting the system, right? Like you can't, if you have as many decentralized oracles as possible, that would be the best way to essentially get like an accurate price. But then again, it is more critical for a decentralized exchange to be very performant, and to have the exact correct prices and low slippage and the best user experience possible. And actually using oracles gives you that to a higher degree than using constant product function, which can enable high slippage, as you mentioned before. So I think that, if you're kind of trying to break it down by, let's say there are 5 factors that a decentralized exchange needs to have, and then there are these 2 options, which is constant product function or an oracle. If you essentially aggregate the scores across each of these functions for the 2 methods that you can use, I think an oracle would win out, which is why I think that this is a sensible decision, but it doesn't mean that you don't recognize the trade-offs that are still there.
Definitely. Even more so for perps, right? Because you're taking leverage, and because your liquidation prices and these margins start getting really tight, you want it to be as accurate and as performant as possible. And I think most users would be willing to take that trade-off of pricing from oracles with that centralization risk in a way from like because of pricing it from centralized exchanges over, having it be completely decentralized, but your trades are more inefficient, and it can lead to pricing inaccuracies where you get liquidated even though you're slightly above your price. Things like that do happen in the
Exactly.
EMM model, which wouldn't happen over here.
Exactly. And another thing, right? Like I think you were talking about the overall options market. I think it's like really important to hammer down on the fact that in crypto, we're nowhere near like how options markets are in traditional finance. I mean, derivatives are the lifeblood of the financial market as we know it today. Because if derivatives volumes are significantly above spot volumes, right? I don't know if you mentioned, what the crypto options volume as a percentage of spot is. As of, I think this was about a few months ago at the start of the year. The Jump Crypto, they did an article around like the state of the crypto derivatives market, and crypto options volume as a percentage of spot is 2% in January, where the market was actually a lot healthier than it is today. So I would assume that this has gone low, but again, who knows? In US equity markets, this number is 35 times the amount of spot volume, right? So if you literally just take that as an indicator of even, in your wildest dreams, the crypto market does not pan out as it does. The one thing that you can, be comfortable in knowing is that the derivatives market at least still definitely has a long way to grow. So I think that that's super important, right? And I think that it's just such a vast space to explore. It's why we've seen so many different types of protocols come up with all these different types of vaults and topex and ribbon, katana, so many structured product protocols, perpetual protocols, like all of those kinds of things. It's such a huge design space which actually can improve, and if it's applied to traditional markets, it can improve traditional markets also significantly. Just the manner in which these transactions using tokens and the qualities of the blockchain are, like you can have a step change in the performance of derivatives markets globally. So I think that it's a huge space that can be explored, and there's so much that there's so much untapped ground still out there.
Yeah, the main problem I'd say is, integrating real world assets and bringing them on chain. That's probably going to be the biggest hurdle in terms of regulation, because I mean, the SEC in the US, for example, wants to regulate every single trade you made on a stock, and they probably wouldn't have the same power they have currently if, trading started moving on chain and, everyone was just using a wallet to trade and there's no KYC process. That would be like anarchy for them, right? So yeah, the market for options and stuff on chain will increase, but there are hurdles and there are reasons why it has not proliferated to the rest of other assets that are out there, and it's only mostly crypto specific still. Like, other than synthetics, there's really no protocol out there that's trying to let you buy different stocks and options on stocks, etc. on chain.
I mean, yeah, like you obviously are waiting for like the big elephant in the room for everything that we talk about as a guaranteed is regulation, right? I mean, that's what is going to impact the future of this market to the highest degree than any other external factor will. So it's obviously a big consideration point with options protocols as well. But it's worth, I mean, even with regulation, I think that the amount of options volume as a percentage of spot crypto volume is going to be a lot higher than 2%, and it and therefore there's a lot of space to grow. And like I just going back to that Jump article, I think that I can quickly, if I can share my screen, I'll show you where Jump has categorized all of these different types of options protocols. I think that might be a bit of a useful mind map or market map for viewers to look towards. So Sid, do you mind just like letting me share the screen? Yeah, screen share. But yeah, like if you just see this graph, right? Like if you see I think that Yash, where would you place GMX in? It would probably be in like a perpetual options. decentralized,
Yeah,
perpetual options, or it would be in like perpetual futures, decentralized perpetual futures.
it
Now,
would
I
be
think that
decentralized perpetual futures.
yeah,
And I
so
think
I
you can
think
also do spot, but I guess this is derivatives. So in this graph, it would be decentralized perps.
yeah, exactly, right. So I think that it would fall here, or some of it might fall here as well. But I think that there are competitors in the market, as you can see here. DYDX, Perpetual Protocol, those ones are some of the main ones. I think that if you actually look at this, if you look at this market map, right? 0, 1 is the only one that actually goes across perpetual decentralized options and perpetual decentralized futures. So I think that would be one that would be good to keep in mind. But looking at the traction that GMX has got, and funnily enough, this is because this graph is from January. It actually doesn't include GMX. If it was done now, it would have GMX in one of the main spots because of the traction that it's been getting. But very important to highlight again how quickly things move in crypto as well, right? Some of these like you wouldn't have even heard of. So actually, yeah, 0, 1 and Derry, but yeah, like some of these you wouldn't have even heard of. So it's important to as like a bit of a benchmark as to how quickly crypto changes and how quickly these products can be developed that just gain significant market traction.
Exactly. And the thing is, they did this with no funding, nothing, no liquidity mining really. I mean, it's pretty crazy the amount of growth they've seen for something that has absolutely no external backing, right? It's completely bootstrapped and it just worked because it's such a good product, right? And I think
also, yeah.
a great sign of things to come.
And also, it actually shows you what the power of composable open source code is, because I'm
Exactly.
sure they use open source code from other protocols to build on top of it, right? Which is why their development cost might have not been as high.
Yeah.
So yeah, it's a very useful barometer for understanding the importance of this open source code, composable Lego blocks of like the DeFi ecosystem, as we've been talking about them since we started this podcast, and obviously amongst ourselves even before we began it. And also just how quickly crypto moves, and how much of an actual, it's kind of like perfect competition really, because you're consistently developing products that are slightly better than the predecessors to improve upon them and therefore gain more and more usage. And this constant cycle of continuous improvement is good for the consumer, maybe not as good for companies to establish their dominance in, but again, for the consumer and like for users, it's a boon.
Yeah. And I also think it says a lot about the team, even though they are anonymous or pseudonymous. The fact that they've been able to execute in such a a fair launch manner talks about their execution ability, right? Even though you don't know them, I don't think that just if you build a good product, users are going to come, right? I mean, people have been saying that all along, but you still need to have some ability to get your product in front of the right audience for the network effects to kick in, and they've done that. So that I think that speaks volumes.
Yeah, I think that like obviously they've been pandering, well, not pandering, that's the wrong word. They've been playing for a crypto native audience, right? Like they've been the product is geared towards a crypto native audience, and it'll be interesting to see how they actually evolve the product to maybe hopefully after regulation is little more embedded, how they pivot their product towards a non-crypto native audience, or maybe towards finance professionals, etc., to actually get them to use these kinds of derivatives in their own traditional, having traditional finance products as options for traditional finance products, or getting them to use options for in a crypto native manner for many crypto products. Like it'll be very interesting to see how they pivot their method. But yeah, to date they've done really well in terms of bootstrapping usage, and just the general vibe around the protocol has been very positive, just because of the fair issuance of tokens and lack of bootstrapping and just the execution pace. And also the tokenomics.
Yeah, and I think this also becomes a Lego on top of which other protocols can build. Because any protocol, let's say you want to build a decentralized option vault protocol, where you're trying to use exotic strategies that, incorporate buying, selling, different things to perfectly hedge and get the strategy you want. You'd want to do that with the lowest possible slippage, right? So protocols themselves would end up using GMX to execute whatever they need to for their users. And because GMX holders are making a fee from all these different protocols every time they trade, protocols themselves could be incentivized to pick up stakes in GMX because they know that, basically, I'm as a protocol, I'm going to be paying GMX a fee. I might as well hold GMX and earn that fee for myself, if you get what I mean. I mean, it sounds like you're
Yeah.
putting money from one pocket into another, but still, right? I mean, they know that so much fees is going to come, and they'll also know who their competitors are.
Yeah.
And then everyone will be paying those fees to GMX, assuming that they are the premier destination for executing options trades.
Yeah.
Then automatically you would want to pick up a stake in a protocol that is going to grow based on your industry knowledge, right? So it could lead to something like Curve, where everyone is competing for the same Curve rewards, and I guess competing for liquidity. This could be the same thing where everyone is competing for the same fees and trying to accumulate the biggest stake possible to get a higher share of fees.
Owning the protocols you use is, I think, the one of the main USPs of tokenization as a whole. And this is like just a great use case that you just highlighted, right? Because people,
Yeah.
you're using that feature of owning the protocol itself to really bootstrap, that snowball effect, essentially.
Yeah, and I mean, the way they've done it is really good because there is a very scarce amount of GMX out there currently to buy, because a lot of it is, it's either vested or it's not minted yet with the floor price fund, or, there's different places. So there's actually only around 8 million circulating right now out of the 13 million. And most people who read about it are forecasting that the 13 million will actually never all be circulating at any given point. And to add to that, around 82% of the circulating supply, I think, currently is being staked. So in terms of free float, there's like nothing out there right now. And if there's even a slight increase in demand, the price will skyrocket because of a majority of it is staked.
And I think that that's actually very good, because a token should be used by the people who use the product rather than just as a method of speculation. So kind
Yeah.
of, limiting the latter as much and, prioritizing the former, as GMX seems to have achieved up until now, is a very good sign. It's a very good sign. It's a very good, North Star to be aiming towards for protocols.
Yeah, definitely. There's no mercenary capital, right? Because they're not just giving out unnecessary farming rewards to people
Yeah.
providing liquidity. And people are incentivized to stay on the platform long term because they're earning real yield, right? And that's very rare in crypto to see.
And yeah, and hopefully it's a direction that we build towards, which it seems like we might be.
Hopefully.
Yes.
Anyway, guys, I think that's all from me. It's been a complicated topic for sure, but very interesting nonetheless.
Yeah, definitely. Same. Nothing else from me as well. And thanks everyone for listening in. Please don't forget to like, share, and subscribe. Subscribe to our newsletter as well, where we'll have a detailed article about GMX released as well, assessing all of the aspects that we spoke about here and then some more. And yeah, great episode, guys. Thanks so much for joining in. Thanks, Yash, for doing the research and everything. And yeah, see you guys next time. Cheers.
See you guys. Have a good one.